Hey folks, welcome back to the channel. It's Liquid here, and today we're going to talk about trailing stops, which is a useful strategy for systematically getting out of your stock positions. I'll basically explain in this video how to set a limit for the maximum possible loss on your sell order without limiting the maximum possible gain. Now, there's no guarantee your order will fill, but if it does, you get to sell a stock at the price that you want, locking in profits. The way it works is you tell your broker, if the stock market falls, then sell. But if the market continues to go up, then stay invested and hold on to the shares. So for example, this black line here represents a stock that you just bought and your entry point was right here. As soon as you own the stock, you can put in this trailing stop trade, which creates a spread or a trailing amount below the stock price. So when the stock price goes higher, your trailing stop follows it and increases as well. But when the price of the share falls, the trailing stop remains the same. And the idea is this trade will trigger and you will get out of your stock when the black line falls below the blue line. So as long as the stock keeps going up, your trailing stop sell order will not execute. But as soon as the stock price falls a lot, let's say like this, that is when it crosses your stop loss. You will sell at that market price, essentially taking profit. So you bought the stock over here and you sold it over here. So you reduce your downside risk since the trailing stop price can only go higher, but you can technically have unlimited gains because as long as the share price moves higher, your trailing stop will follow with it. So here's an example of putting in a trailing stop. I purchased this stock here, PLTR, last year. So far, what I've been doing is just selling this. So I right click and then I click sell. But today I want to put in a trailing stop because if PLTR continues to go up like in the past few days, then I want to not get out of my position and continue to ride this momentum upwards. Now it could bounce off this blue line, the 21 exponential moving average, and continue falling further. So if that were to happen, then that's when I want to get out. If I go to the 15 minutes chart and zoom in here, each one of these large columns is a day. So I need to consider two things for a trailing stop. The first is the stop price, and this is the price of Palantir at which my order is triggered. And because I'm selling the stock, I want to put that stop price below the current market value of $70.29. So for example, if I put it at $69 at this purple line here, then this tells my broker that as long as this trade remains in place and I don't cancel it, then only trigger this trade if the price falls to $69. So this is my initial stop amount. So over the next few days, if PLTR goes up, down, and maybe even down quite a bit, but doesn't reach $69 and continues heading upwards, then my sell order will not be triggered and I will continue holding on to those shares. But if it were to go below, then that is when my trailing stop order will be triggered and I will sell however many shares I've decided to place in that order. So why did I say this is the initial stop price? Because we have to consider the other thing in a trailing stop order, which is the trailing amount. Now, sometimes the trailing amount is where the trailing stop is, so you just have to consider this one variable. But other times, the trailing amount would be slightly below your stop. So for example, if the stop was this red dot, that is your initial stop price, your trailing amount is going to start down here, and it won't actually take into effect until the share price moves higher and the trailing amount goes above the initial stop price, which is right here. So depending on the broker, you might have just one number for the stop and the trailing, or you might have them separated. Okay, so I'm going to put in an order to sell maybe 20 shares of my PLTR. Here is the order entry form. Now, instead of a limit order or a market order, I'm going to choose a trail. Okay, so this is going to be a trailing stop order. And these two inputs here are the ones I just talked about. So first we have the stop price, the initial stop at which I want this to trigger. And I'm going to keep it fairly simple. The stock is at 70.5 right now, so I would choose $70. And what that means is if I move this up to 70, it means if PLTR drops below this purple line, then I want to get out of my position. And right now, looking at the 15-minute chart, the purple line is at about where the 21 EMA is. Now, the second input here, this is the trailing amount, and you can set a dollar amount or you can set a percentage. In this case, I'm just going to go with amount to keep it simple, and I'll just set it to $1. So right now, the share is 70.5. If the share goes to 72, my stop loss will increase and go to 71 because I have my trailing amount set to $1, and 71 is $1 away from 72. If PLTR goes to 73, my stop price will rise to 72. And then for the duration, I'm just going to say good till cancel, and then I will submit my order. So here it's saying if it gets filled, at least right now, the proceeds will be $1,400. But again, if the trailing stop goes up because PLTR has gone up, then the amount I make can be more. And this is why your upside is not limited. So I'm going to submit that. And here we see the order. It was just put in at 11:35. While you have this entry in place, before it gets executed, you can still change any of these settings, like the number of shares or the trailing amount, if you change your mind for some reason. And while we wait for that order to play out, I'm going to use another example using TD Web Broker instead of IBKR, just to show how it looks like on different platforms. So I have a purpose Bitcoin ETF here that's gone up a lot, and I have 500 units of these. So maybe I will get rid of 100 using a trailing stop order. So I'm going to sell, symbol name, this one, sell. For the type of trade, I'm going to choose a trailing stop. Now there's a couple here. The normal one is the trailing stop market. I'm going to talk about the limit in a bit, but this is the standard one. Now they call it trigger delta here, which is the trailing amount. So they just named it differently. And again, you can choose dollar or percentage. I want to get rid of 100 shares, not all 500. And good until, well, I can choose a specific day. Let's say I don't want this order to carry out, after like this month or the end of the year. So I'll just say maybe January 31st. TD doesn't let you set an initial stop price. So all you really have is the trigger delta or the trailing amount. And what that means is you still have a stop price. It's just going to be determined by whatever this trailing amount is going to be. So I'll keep it pretty small, like 0.1. And it's saying the market right now is at about 20.37 because the trigger price is 20.27. And I will preview my order, selling 100 shares with a trailing amount of 10 cents. Okay, so the current price is 20.41. So it's probably gone up a little bit. Right now it's pending. We'll just wait and see what the price does. And we are near the end of the trading session. You can see at 3:22, PLTR fell below $70, and that is when this trailing stop order was filled. 12:22 Pacific, 20 shares filled at $69.98, close enough to $70. What about the Bitcoin Trust? Looks like it is not going to fill, and although the market did come down by the end of the day, it wasn't enough to trigger the 10-cent move, and because this is an ongoing order, it will remain open overnight. So let's see what happens tomorrow. Alright, it is now Friday, the last trading session of the week, and my 100 shares of BTCCB was filled at 29.8, higher than yesterday's close. And I was able to sell those shares at 9.39. The reason because if we look at the stock price at 9.39, which was right here, there was a 10-cent drop from about 21.09 down to 29.9 or 29.8. That's when it got filled. So this is an example where a trailing stop order can give you a higher profit than just placing a market order. Because yesterday, had I placed just a market order, I would have gotten out, somewhere around here because that's where the price was yesterday. But with a trailing stop, I did not limit my upside. And as long as the price wants to continue going up without retracing too much, then my trailing stop would follow that price higher, increasing the exit price that I would sell at. And that is how a basic trailing stop order works. But like I mentioned earlier, when the order is triggered, it places a market order. But that can potentially be a problem because look at this scenario. Apple shares were trading at about 220. This was several months back. We're looking at the hourly chart here, and you want to put in a trailing stop order. Apple has a pretty low beta right now, so maybe you want to set the trailing amount about 5%. And if you put the trade in during the middle of the day, then 5% would be around here at the 211 level. But Apple is about to release earnings after the market closes. So let's see what happens the next day. We have a big gap down. So you can obviously see the problem. Your stop price was 211, but when Apple opened the next day, it started down here at 199. So even though you wanted to only take a 5% maximum loss, you actually sold at a 10% loss because when the market opened the next day, the trailing stop order was triggered at the market price of $198 instead of the 211, which you had expected to be your exit price. Now, what can we do? Fortunately, we can adjust the trailing stop order to limit the amount of money we can lose by setting another price below the stop price. So we'll set that limit to $2 below the stop price, so which will be 209. And this is called a trailing stop limit order instead of just a regular trailing stop order. And how it helps me in this scenario is when Apple opened the next day down at 199, since it's below my 209 limit, I'm still holding onto those shares because I'm telling my broker that yes, I do want to get out if the stock price drops to 211, but the limit at which I would be willing to sell is $209. So if the price goes below 209, I do not want to sell. So my order actually wouldn't get filled until the stock price goes back up during the next hour and it would get filled at 209. With the trailing stop limit order, you're combining the benefits of a stop order and a limit order into one entry. So just to be clear, my order was already triggered as soon as the price fell below 211, my stop price. Once the order is triggered, it looks at your instructions to see if it's a market order or a limit order. If it's a market order, it fills right away at whatever the stock price is at the time. If it's a limit order, it looks at the limit amount and only sells if it goes above that. And in this example, it's useful because instead of selling at 199, I'm selling at 209. So I save myself $10 per share. So here's an example of how that works. I'm going to use my IBKR portfolio here again. I have 300 shares of Peloton. Maybe I'll get rid of 100 shares. And this time I will be doing a trailing stop limit order. So looking at Peloton here, it's trading at about 8.3. The last level of support looks to be down here around 7.3. And when it dropped below that, it was resistance, but now it's back up above that again. So I'm going to set my stop target to 7.3, that level of support. And for my limit offset, I'm going to choose 30 cents from the stop. So that would put it at $7 for now. So looking at the order entry form here, I have PTON that I'm going to sell. I have 300 positions. I'm selling 100. I'm going to choose a trailing limit instead of a regular trailing stop. So a trail limit is basically a trailing stop limit order. The LMT or limit is going to be the price that has been offset from the stop. So in this case, my limit is $7, which is 30 cents below my initial stop. And my stop is 7.3 because that is ideally when I want to sell my 100 shares. So LMT, I'm going to type in here $7. For the stop, it'll be 7.3. And then for the trailing amount, I'm going to use a percentage. And it's going to be roughly the difference between where this share price is at now to my stop target, which is about 12%. So I usually add a couple percentages more, especially if it's a volatile stock like this. So I'm going to choose 15% as my trailing amount. And all that means is if Peloton goes up to like $10 before heading down, then the stop would be raised to 8.5 because 8.5 represents a 15% drawdown from $10. And instead of expiring on the day, I will choose good till cancel. So my final order will look something like this. Now, having a trailing stop limit like this, so you're limiting your downside, is good if you're trading really volatile stocks, but at the same time, your order is not guaranteed to go through. Because let's say for Peloton, for some reason it gaps down here starting the following day and continues going down like this. If I had used a market order instead of limit, then I would have sold here. But because I have a limit order at $7, I continue to hold the position and I'm just left holding the bag as the price continues to drop. Now, that is a worst case scenario, but it could happen, which is the downside of adding a limit to your trailing stop order. And on a similar note, trailing stop orders in general, even the market order ones, are bearish in nature. So although they can potentially give you a lot of upside, you can get stopped out on a bull trend. So if you go back to the Apple example, which I was showing earlier, like back in August, big gap down. Had you use a trailing stop order at, the 211 level or 209 and you got stopped out of your position, look what happened over the next few months. Each candle represents a day. You basically would have missed out on all of those gains because you sold over here. And this is one of the inherent risks of a trailing stop, is that if the market does a quick reversal like this, then you would have, yes, locked in your gains, but at the same time, you've locked in your gains. So you also throw out any potential profits that those shares could get you in the future, which is why the way I use stop losses is I do a portion of my holdings at a time and not all the shares. It's a way to manage risk rather than a trading philosophy. Now, just a general rule of thumb of how much you should trail the stock price when you're putting in these orders. As you saw in my PTON example, I use 15% because Peloton has a pretty high beta, meaning it's quite volatile. Apple has a relatively low beta of just 0.86. So anything below 1, I like to have a 5% trail. TD is another example, which has a beta of 0.57. So I go with like a 5 to 10% trail. For anything with a beta around 1, like the general S&P 500, I choose like a 10% trail limit. So if I put the order in today, the market would fall to about 540 before I would get out. And the only reason that looks like a big drop is because the market has been pretty much on a bull run for the last couple of years. And I don't want to use a trailing stop that is too tight because this is what a 10% drop looks like. If I were to draw a channel, you can see it's pretty much the thickness of the channel plus a little bit more, right? So that way, if it goes to the top of the channel and starts dropping, I won't get out until it comes down about there. Because if I choose a shorter trail, like 5%, like with a low beta stock, then there would have been at least a couple of times over the last year, just in 2024, where I would have gotten out of my position. Like there's another example in December, just last month. But even though it fell more than 5%, it did not break out of this channel. Again, 10% is just a general rule, but in this case, it would have filtered out the false positives and it wouldn't have gotten stopped out along this bull run. For higher beta stocks, NVIDIA with a beta of 3, that's really high. Let's talk about the betas between 1 and 2 first. Those I would use maybe like a 15% trailing stop, but it's going to depend on the individual stock. And then for things like NVIDIA, where the beta is 2 or 3 or higher, or even cryptocurrencies, then you can go 20% or even 25%. It just depends on the individual security that you're trading. And of course, all brokerages should have the trailing stop limit order form. So in TD, for example, it has the regular trailing stop market as well as a limit version. So that's it for now. Hopefully you found this tutorial useful. And next time you want to sell a portion of your stock to take some profits, you could consider putting in a trailing stop order instead of just a regular sell order. So thanks a lot for watching. Let me know if you have any questions below, and I'll talk to you in the next one.